Ever watch a glitch ripple across your screen and think, maybe the world's just buffering, energy sector included? Right now, we're tuned into a channel where the volume knob is stuck on volatility, security keeps flickering in and out, and the affordability caption is rolling by a little too fast. All the while, the promise of decarbonization keeps popping up in a corner window, reminding us that while we're busy juggling today's crises, tomorrow's network upgrade is already overdue. The trick isn't to pick a favorite signal, it's to keep the picture from freezing while we splice security, affordability, and decarbonization into the same mainframe. Let's start with oil. Demand has been more than stubborn. It's been more stubborn than the obituaries predicted. Jet fuel is back. Petrochemicals are hungry, and road fuels are holding up, even as efficiency gains nibble at the edges. Most credible outlooks now put global oil demand near record territory, with a slow climb that flattens later this decade rather than collapsing. On the supply side, OPEC Plus retains real leverage. Managed barrels have turned volatility into a policy tool, and spare capacity, still concentrated in a few hands, acts like a seat belt and a switchblade, depending on your point of view. U.S. production remains remarkably resilient. Capital discipline is no longer a slogan, it's muscle memory. Shale operators are drilling fewer but smarter wells, focusing on cash returns, not volume trophies. Net results, the United States is still a swing factor, but not a blank check. Geopolitics threads through this picture. The Middle East remains a powder keg, risk premium, and shipping lanes from the Red Sea to the Strait of Hormuz are a live variable and not a footnote. Russian crude continues to move, rerouted, discounted, blended, masked by creative logistics that would make a Hollywood prop master very proud. Sanctions changed trade routes. They don't erase molecules. India and China have become price setters on the margin for discounted barrels, while Europe learned the hard way that diversification beats wishful thinking. We now live in a multipolar barrel market where policy and plumbing are equals. Gas has its own plot line. Call it resilience with regional personalities. In North America, abundant supply and rising associated gas kept prices softer than producers like, but the LNG build-out continues to redraw the map. Each new train binds U.S. shale to global weather, storage, and geopolitics. In Europe, the scramble of 2022 and 2023 forced efficiency leaps, accelerated renewables, and rewired LNG infrastructure at record speed. Storage strategies grew overnight. The immediate crisis has eased, but the continent's margin for error is still thin when winters bite and Asian demand pulls cargoes east. In Asia, gas remains a growth fuel, especially as coal-to-gas switching defends air quality and grid stability. Yet affordability sets the pace. Long-term contracts are back in fashion. Spot exposure is a teacher and it grades on a curve. Now to renewables, the most dynamic chapter. Costs have fallen dramatically over the past decade, even accounting for recent speed bumps in supply chains, interest rates, and interconnection queues. Utilities scale solar and onshore wind are competitive across geographies. Offshore wind faces a tough year with bid restructures and inflation. But fundamentals, high capacity factor, proximity to load centers still matter. Storage is moving from a sidecar to engine. 4-hour batteries are spreading fast for peak shaving and solar shifting. Longer duration solutions are advancing through pilot mode. Grid constraints, however, are the common choke point. You can't decarbonize what you can't connect. Transmission permitting timelines remain out of sync with project build times and interconnection studies are the new DMV line. Everyone waits. No one smiles. Policy is the quiet giant in the room. Industrial policy in the United States, through incentives, credits, and demand-side programs, has catalyzed manufacturing renaissance across clean tech components, from electrolyzer to battery materials. Europe is countering with its own mix of subsidies, standards, and carbon pricing architecture, determined not to be only a buyer of technology. China remains the leader in solar batteries, supply chains, compressing costs and timelines in a way few can match. The competitive tension is real. Who captures value? Who captures volumes? Who captures leverage? That contrast will define both margins and national security debates for years. Now let's talk economics. Higher interest rates changed the math. Capital-intensive projects, offshore wind, nuclear, large-scale transmission, they feel the pinch first. Developers revise bids. Utilities are rerunning models, and financiers are rediscovering the boring beauty of contracted cash flows. Meanwhile, efficiency investments suddenly look like blue-chip assets, low risk, fast payback, measurable impact. Demand-side flexibility, think demand response, smart charging for EVs. And behind-the-meter storage turns kilowatts into negotiable instruments. In oil and gas, cost inflation and service bottlenecks eased from their post-pandemic peaks, but we're not back to 2019. Productivity gains and digital operations are doing heavy lifting to protect margins. Speaking of digital, data is the new pipeline, and it leaks as if you don't secure it. AI is crawling across the value chain. Predictive maintenance for turbines and compressors, subsurface modeling, trading analytics, and customer segmentation for utilities. The winners won't be those with the fanciest model. They'll be the ones who pair model accuracy with process discipline and cyber hygiene. A compromised control system is more than an IT problem, it's a physical risk. Resilience means redundancy, visibility, and practiced incident response. Hydrogen deserves a sober minute. Green, blue, turquoise, colorful debates, but at the end, use clarity matters more. Hydrogen will not be the WD-40 for every decarbonization squeak. It is compelling where molecules beat electrons, refining chemicals, high temperature heat, certain heavy transport, and seasonal storage in specific geographies. Costs are falling, but logistics, standards, and demand alignment must mature in tandem. The smart money is moving from build it and they will come to build it where they already are. Carbon capture and storage is crossing from pilot theater to early scale reality in clusters tied to industrial hubs and CO2 pipelines. Permit pathways are still clunky, pore space agreements are complex, long-term liability frameworks need clarity. Yet the physics is sound and the policy scaffolding is getting stronger. CCS is not a hall pass for unlimited emissions. It's a tool for the hard to abate. Treat it that way, and it earns its keep. Electric vehicles keep climbing with adoption curves shaped by incentives, charging availability, and model variety. Fleet electrification is a bright spot, predictably, with their routes, depot charging, and clear TCO benefits. The grid impact is manageable with time of use pricing and smart charging, but unmanaged clustering can stress distribution networks. Planning must move from retrospective to predictive. If you design substations using yesterday's load shapes, tomorrow will send you a correction. Let's stitch the threads. Energy transition is not a light switch. It's a reconfiguration of an $8 trillion a year machine. While it's running, under load, with the audience watching, 3 truths hold. First, volatility is a feature, not a bug. Policy shifts, weather extremes, and geopolitics will keep price bands wide. Build strategies that snack on volatility rather than choke on it. Flexible offtake, diversified feedstocks, modular projects, and risk-sharing contracts. Second, scale beats slogans. Announcements don't decarbonize. Steel in the ground does. The constraint set is practical. Permits, skilled labor, transformers, ports and grids. Execution excellence becomes a competitive advantage as powerful as technology. And third, transparency compounds. Markets reward reliable data and credible plans. Whether you're an oil-producing Markets reward reliable data and credible plans. Whether you're an oil producer disclosing methane performance, a utility mapping interconnection timelines, or a developer pricing in community benefits, trust lowers capital cost. So what do we do right now? If you operate in oil and gas, hold the capital discipline in line. Double down on methane elimination and bake carbon intensity into your marketing strategy. Optionality, that can be your friend. Portfolio balance across basins, products, and customers. Treat Scope 1 and 2 reductions as cost control. They often are. If you're in power and renewables, prioritize projects with grid-ready paths. Interconnection savvy is a moat. Hedge rate risk early and structure offtakes that share inflation exposure. Invest in storage where price spreads are durable, not just fashionable. And get serious about O&M digitization. Uptime is your margin. If you touch infrastructure or policy, synchronize timelines. Transmission needs a permitting fast lane with community co-design, not just consultation. Modernize market rules so flexibility gets paid for the value it provides. Align industrial policy with workforce development. No transformers, no transition. If you finance, reward proven teams, not just shiny technologies. Underwrite supply chain resilience and cyber readiness. Blend public and private capital where externalities are real. And insist on measurable milestones. Cheap money is gone. Smart money should get louder. And to everyone, resilience is cultural before it's technical. Foster teams that learn fast, communicate plainly, and adapt without drama. The future pays a premium for operators who can navigate uncertainty with curiosity and composure. We're not choosing between old energy and new energy. We're building a system where molecules and electrons learn to dance without stepping on each other's feet. Oil and gas will be with us for decades, even as their roles shift. Renewables and storage will continue to climb the merit order. Grids will get smarter, customers less passive, and data more decisive. Geopolitics will test our nerves. Economics will test our models. Reality will test our timelines. That's the message blinking through the static. Innovation meets grit, ambition meets real-world limits. The future isn't handed over. You have to tune out the noise, tune into the signal, and build what lasts. I'm Mark Roach. This is FutureWise Energy. Subscribe, question, glitch forward, and let's shape a smarter energy future together. See you on the next broadcast.